In 1971, a postman in California bought a small house for $24,000. He did not time the market, he did not read a finance book, he did not have a spreadsheet. He just bought a house because he needed somewhere to live. That house is worth $1.4 million today. Now here is the uncomfortable part. His son, who went to college, got an MBA, picked stocks, diversified his portfolio, is worth less. Significantly less. So what did the postman know that the MBA did not? Nothing. That is the point. Real estate has made more ordinary people wealthy than any other asset class in history. Not the stock market, not gold, not Bitcoin. Real estate. And the reason is not what most people think. It is not location, it is not timing, it is not even the property itself. It is the structure of the deal. And once you understand that structure, you will never look at a house the same way again. Let us start with the basic math, and I mean basic because the system is almost embarrassingly simple once you strip away the noise. You walk into a bank, you have $50,000, you want to buy stocks. The bank says, great, here's $50,000 worth of stocks. That's it. Your $50,000 buys you $50,000 in assets. Now you walk in and say, I want to buy a $250,000 property. The bank says, great, put down $50,000, we'll lend you the other $200,000. Same $50,000, but now you control a $250,000 asset. That's leverage, and leverage is the engine underneath every real estate success story you've ever heard. Here's where it gets interesting. That $250,000 property goes up in value, not by your $50,000 portion, by its full value. So if the market rises 10%, your $250,000 property is now worth $275,000. That's a $25,000 gain on a $50,000 investment. That's 50% return. The stock market returned 10% that same year, you made $5,000. Same starting money, same market conditions, the real estate investor made 5 times more. And you can't do this with Apple shares. The bank will not lend you $4 for every one you put in to buy a tech stock. Too risky, they say. But a house they trust. Now let's add the second layer, because leverage alone does not explain the postman. Someone is paying your mortgage. If you rent out that property, even partially, your tenant is, month by month, paying down a debt that you own. You're building equity with someone else's money. The asset is becoming more yours without any additional effort from you. This is the part financial advisors tend to gloss over. In almost every other investment, the asset just sits there. It doesn't generate cash to pay for itself. A share of stock doesn't send you a check every month to cover its own cost. Real estate, structured correctly, does. Rent comes in, mortgage goes out. The gap between the two, even if it's modest, is income, and the underlying asset, if history is any guide, keeps appreciating. You're being paid to wait. That's a sentence that very few investments can honestly claim. Now add the third layer, tax. Governments almost universally treat real estate with extraordinary generosity. In the United States, you can deduct mortgage interest, you can deduct depreciation, which means the government lets you claim your property is losing value on paper, even while it gains value in reality. You can defer capital gains taxes through a mechanism called a 1031 exchange, rolling profits from one property into the next without a tax bill. Warren Buffett, a man who has spent 60 years thinking about how to grow wealth, has said that his personal residence is one of the best investments he ever made. He's not saying that to be folksy. He's saying it because the combination of leverage, cash flow, and tax treatment creates a compounding machine that almost nothing else can match. Here's where I have to be honest with you, because this is not a pitch, it's an explanation. Real estate can absolutely destroy you. Leverage is a multiplier. It multiplies gains, yes, but it multiplies losses with equal enthusiasm. Buy at the wrong time, with too much debt, in the wrong market, and the same structure that made the postman wealthy will swallow you whole. 2008 is not ancient history, It's a reminder that real estate markets do not only go up, and that the bank does not particularly care whether the market is cooperating when your mortgage payment is due. And there's the illiquidity problem. You can't sell 3% of a house when you need cash. You can't rebalance a property the way you rebalance a portfolio. If circumstances change, your job moves, the neighborhood declines, the roof collapses, your options are slow and expensive. There's also the management problem. Real estate is not passive in the way a dividend stock is passive. Tenants call, things break, local regulations change. Property management exists precisely because real estate at scale is a business, and running a business is not for everyone. So why does real estate keep winning generation after generation, despite all of this? Because of what it's made of. Land is finite. They're not making more of it. Population keeps growing. People need somewhere to live. Governments are structurally incentivized to keep real estate prices from collapsing. Too many voters own homes. Too many bank balance sheets are backed by mortgages. The system, for better or worse, is designed to protect real estate values. And then there's the psychological dimension. Most people won't sell their house the moment the market dips. They live in it. They hold it. They ride out the corrections without even realizing they're doing something that equity investors find nearly impossible, staying in the game long enough for time to do its work. The postman held his house for 40 years. He didn't panic. He didn't check the market. He just kept making payments, and time did the rest. Here's the question nobody quite answers cleanly. Is real estate the best investment, or is it simply the investment that human psychology is best suited to hold? Because the returns, when you strip out leverage and tax advantages that are unavailable to most other assets, are actually not that different from a diversified stock portfolio over long periods. What is different is behavior. Real estate forces discipline. It forces holding. It forces you into a position where selling requires significant effort, and therefore most people don't sell when fear tells them to run. Maybe the edge was never the asset. Maybe the edge was always the investor. And if that's true, if the secret ingredient is just patience, enforced by a structure you can't easily escape, then the real question is not whether to buy real estate. It's whether you have any other system in your life that forces you to hold when every instinct tells you to run. Most people don't. The postman did. He just called it home.